Cutler YMX uses the Netrodyne two-way camera system in all of our power units. The Netrodyne cameras have more than once exonerated a driver who was perceived to be at fault, as well as saved our Cutler YMX from paying damages related to an accident. We are already seeing, just in 1 year of Netrodyne, the impact of better safety scores and fewer damages and incidents in our insurance rates.
Assume all is going well. We're here. Freightonomics this week. Zach Strickland, Director of Freight Market Intelligence, here with Tony Mulvey, Senior Analyst. And we are fortunate enough today to be blessed by Dr. Zach Rogers, who we'll bring on in a minute to discuss some of the LMI things and some of the supply chain trends. We haven't talked to him in several months. So I'm really excited for that. We had Prime Day this week as well. And of course, JB Hunt earnings disappointed the analysts there. Not sure how much we're going to spend on that because I want to get to Dr. Zach Rogers. But Tony, it's Prime Week.
It's Prime Week, and hey, we're sponsored by Netrodyne, so thank you, Netrodyne. So remove the guesswork from driver management and fleet safety and start predicting your accident reduction cost savings. Netrodyne's AI-enabled video safety platform corrects unsafe driving habits, recognizing and reinforcing great driving. With the Green Zone score, your fleet of engaged drivers will protect your bottom line. Every 50 points earned is a 14% cut to your accident rate. So thank you, Netrodyne, for
sponsoring
Freightonomics. And Zach, we want to get to Dr. Zach Rogers as fast as possible. So we need to kind of kick it off where we are in the market with your market in two. So Zach, I'll count you in 3, 2, 1.
All right. Tender rejection index, the OTRI here. It would take me, having written an article just recently talking about how 2019 could be the blueprint for the rest of the year for the OTRI to surprise to the upside on me. This actually isn't that big of a surprise to me. I feel like this is certainly not the same environment we had in 2019. Capacity is leaving at a much bulkier, faster rate. That environment was much more stable than this one is. So it doesn't necessarily surprise me that we see a little bit of divergence here. That August in 2019 was extraordinarily soft. We're staying a little bit more elevated here, even though the rejection rate, historically speaking, is pretty low. But it is taking time to kind of fall down, as it typically does in July, and it has come off that July 4th high. But it's staying a little bit higher, a little bit longer, not following that 2019 trend. Thank you so much for breaking my promise. Tender rejection index. Let's go to the next one. NTIL, the spot rate, doing the same thing, just holding up a little bit higher than where it began. Some stickiness here in July. We normally don't see this. July is the most vacation time of year, but outside of the holiday period between Christmas and New Year's, tend to see freight volumes and things fall off a little bit here. I think that's still happening, but rate stickiness definitely occurring more than we expected. Tender volume index, let's go to the next one, OTVI, and talk about demand. This one probably is less relevant to a lot of the transportation service provider segment because it's still not enough demand to really break through that threshold of making it feel like a tight freight environment where you have upward pressure on rates. It is maintaining these rates, however, and this OTVI, if you notice, isn't falling down in its July lull as we traditionally see. So tender volume still remaining a little bit higher. Let's go to the last one. Talk about that maritime peak season coming up. IOTI, which measures 20-foot equivalent units, coming into the United States, also on the rise and continuing to feed the domestic freight market.
Yeah. I mean, Zach, that last chart I think is the most telling. You're seeing a rise in ocean volumes overseas. You're seeing darn near record highs here already clearing the ports. I think June numbers were just off of the all-time high, and they've been rising throughout the year. So I think it kind of sets up our discussion with Dr. Zach, about kind of where the market is and where it's really headed. Because, you start looking at things and it sure seems like we're on a positive trajectory from a freight market perspective.
Yeah, I think the narrative that we've been talking about is that, hey, it's coming, it's turning. It just doesn't feel like a very violent, aggressive turning. And it's not. It's, demand conditions are relatively good despite some of these economic figures that come in. Prime Day was a success. The stock market didn't care.
Yeah.
I'm befuddled by the financial sector. Constantly, we talk about this a lot. I'm a finance person myself, and one of the reasons that I kind of turned a blind eye to it at times because it just confounds me.
It doesn't
I don't
make
understand
sense.
it.
Yeah, I mean, you had Prime Day sales, up 11% year over year, and Amazon stock sells off 30% today. It's like the two, you would think you have record sales for Prime Day would help boost this, but it just doesn't seem to. It's almost like good news or positive news is bad news, and bad news is good news.
I mean, JB Hunt had, they always come out first with their earnings report, missed to the downside on the earnings expectations. Intermodal, the only thing about this that kind of confused me was their intermodal volumes dropping amidst an environment where we saw domestic intermodal volumes really thrive. And it feels like they lost an account or some market share here. The rest of this business, though, outside of some of these cost figures, I don't really have a concern about. Their OR actually went up or down, depending on your perspective. It improved in their truckload sector.
Yeah.
Their volume was down, but this could be simply just them turning down bad pricing.
Yeah, I mean, same thing in their brokerage, right? I mean, you see a massive decline in volume. I think, up to I think it was 25% reduction in volume, but revenue per load was up in the quarter. We haven't talked about too many revenue figures on a per load basis going up anytime recently.
Revenue quality, especially in a down cycle, is very important to maintain. So when I talk to some of these financial people, I'm like, guys, you really have to read the tea leaves here. Some of these things that look bad in the near term can manifest to positives in the long run. Now, the intermodal is another question altogether. But of course, I kind of want to pose this question to Dr. Zach Rogers about, I read something, if we can go ahead and bring him on and introduce him real quick. I've got a question for him that I want to go ahead and just have him respond to me organically on this one leading question. And welcome back to the show, Dr. Z.
Oh, thanks for having me. Let's get into this question though, because now I'm excited.
Yeah. So Dr. Zach Rogers, Associate Professor of Supply Chain Management at Colorado State, one of the primary contributors to the LMI, Logistics Managers Index, which we will, of course, have to discuss. One of my favorite things to look at. So, Dr. Z, I was reading Bloomberg the other day, and I came upon this, kind of this reference to a podcast. This economist Joseph Stiglitz, Nobel Prize winning, economist, I guess, or supply chain person to some extent. I don't know who he is. He's a Columbia professor and former World Bank chief economist. So he obviously knows something. And he outlines, and they summarize this podcast, which I'm excited to probably go check out. Basically inferring that the reason that the pandemic was so harsh was we've kind of overblown this just-in-time mentality in the way that we don't really value risk aversion practices. We talked about the financial sector. Quarterly earnings, that's what matters to shareholders. They want to know, if you're a hedge fund manager, you're really just trying to get in and out of a stock 6 to 9 months. This short-term sentiment. I've talked about the T-bill in this context about how we see the short-term interest rates really going up above the long-term. Is this short-term sentiment growth really doing a lot of these supply chains disservice? And do you feel like this is a trend that is ongoing right now, and why these supply chains are so exposed and vulnerable to some of these economic shifts?
Sure. So that is an interesting idea that JIT caused some of the pandemic issues, because it is true that there were certain pieces of the economy where, because supply chains were stretched out long, there's an old maxim that says JIT and oceans don't mix. And we seem to have forgotten that going into 2020. And so the JIT where we're relying on, hey, we got to come across the ocean. Sure, we had problems there, and that's why you see some things coming back, either near-shored or reshored. that are really critical. That being said, there was also this conversation at the time that said, oh, it can't be JIT, has to be JIC, has to be just in case. You really need to build inventories up, and that's what will save us. Okay, well, what happened in 2022? So yeah, in 2020 and 21, we had shortages because we were too JIT, and so everyone reacted against that and said, okay, well, we better blow up our inventories. What happens in 2022? In 2022, we have more inventory. If you look at inventory to sales ratios, or if you look at the LMI inventory levels, the only month we've ever been above 80 was February of 2022. And we had huge problems. People are taking billions of dollars in write-downs of inventory. It's one of the main causes of inflation that we had in early 2022 is that everything was so full. We had all this, all of our storage got incredibly expensive. For the warehouse guys, it was nice that everybody decided they didn't like JIT for a while, but for everyone else, things got really, really expensive. And so I would push back on Dr. Stiglitz, Joey Stiggs to his friends, I'm sure. I would push back on that because yes, JIT exposed us, but JIT exists for a reason. Okay, it's not about should we have a little bit of inventory or a lot of inventory. It's should we have the right amount of inventory. Okay. And that's why you see the companies that did well during the pandemic, like say Toyota, who was usually the poster boy for lean. Well, they built up the things that they knew would be hard to get, and then they kept other things lean. And so it's not about being dogmatic one way or the other, JIT, JIC. It's about, like with anything in business, look at the environment you're operating in and then tailor your solution to the environment. Don't try to tailor the environment to your strategy. Tailor your strategy to the environment. And so, yes, JIT was a problem in 2020. JIC was a problem in 2022. And today, you know what we really see when we dig into our report, especially looking at downstream firms? JIT is back. And that's why we're seeing these big bubbles of inventory coming in now. The Port of LA, week over week, according to their signal email, TEUs are up 51% this week year over year and 35% next week year over year. You know what that looks like? Seasonality, and it's the seasonality that's associated with JIT. So while I do agree it could be a problem, and yes, if you're over reliant on something an ocean away, you do open yourself up for exposure. If you don't have JIT, you can open yourself up for problems the other direction. And it's honestly something we teach our intro classes, the bullwhip effect. Things go up, things go down. And if you overreact either way, that's when you get in trouble.
Absolutely. I think this actually leads into a good thing with the latest LMI report. I mean, we were in overall at 55.3 for June, slightly down for May. But I mean, we've been in this expansion territory now 7 consecutive months. Yeah. But then now we look at inventory levels. They've been in contraction for 2 months. I mean, we've seen this. You can see the movements here. I mean, what is the takeaway when we look at inventory levels in contraction? I mean, is this that right sizing of inventory, just kind of moving back to call it just in time, especially where you said, I think it was the upstream firms or it's back, or downstream firms back, is that overall theme?
That's right. So downstream firms would be like retailers, and that's where we really do see just in time. So you had up on the screen there the overall inventory number, which I believe was a 47.4. And 47.4 is mild levels of contraction. So it's been a while since I've been on the show. For those of you who don't remember how it works, any number above 50 is growth, any number below 50 is contraction. Further below 50 it is, the faster the rate of contraction. So 47.4 is very mild contraction. That's close to inventories are relatively staying the same. Now, where you do see a little more nuance in this is when you break it out between upstream and downstream firms. So downstream firms are like retailers. And retailers in June came in at, I believe, 37 for inventory. So that is contraction. And you expect to see that in June sometimes because we have folks sort of getting rid of their spring and summer inventory. My wife was at Costco on Sunday and started sending me pictures like, hey, grills are 40% off. And also Halloween stuff is coming out. And so that 40% off, that's okay. Let's let's get rid of our summer and spring inventory and get ready for Halloween, back to school, all that stuff coming in. Upstream, however, and this is like wholesalers, manufacturers, distributors, even some LSPs, inventory levels are at 51 and a half. And so that is growth. And so it shows, all right, inventories are actually building up upstream and coming down downstream. And probably what that represents, I mean, this is again like normal seasonality. What this represents is we're building up inventories, like stuff's coming in, imports are coming in, and we're not ready to shoot it down to retailers yet because the sales aren't going to happen, but we're beginning to bulk up again in a way that we haven't really seen since 2021. So one of the problems we've had and why this freight recession has been going on for 2 years is that in 22 and 23, and this gets back to the downside of JIC, we already kind of had inventory was already here. One, we had a lot left over, and two, people were so scarred by the delays we had in 2021 and the ports and getting things across the country that everyone ordered a little early. And so this, to me, the fact that it's a 37 downstream, a 51 upstream, and that both on both sides, their future predictions are that this is going to go up. Upstream over the next 12 months is saying 74. Downstream is saying 57. Okay, so what that tells us is we're just moving now into the sort of seasonal buildup of inventories that we would have expected every year pre-COVID, and that both sides of the supply chain are expecting some growth. And you know, it's a real shift for us in the last couple months that upstream has been busier and busier across the board. I think upstream was either marginally or statistically significantly higher than or busier rather than their downstream counterparts in 4 of our 8 submetrics and the overall metric. That's a real change because all through 2023, upstream was really the lag on the economy. You know, consumers were holding the economy up through spending, some of it on credit cards, some of it on buy now, pay later, some of it just YOLO, I don't know. But upstream was kind of the, you know, the anchor around our neck. And now we're seeing upstream come up as well. And really now that we're going to see, you know, growth on both sides of the supply chain, that to me says we're sort of, nature is healing, we're getting back to normal, and we should be, I think, have a fairly, you know, not incredibly robust, but a strong second half of 2024.
Oh man. So that's the demand component of things. And, you know, economically, it does look like we're doing okay from the demand side characteristics that we look at. But let's flip over to the supply side of the equation here and talk about transportation capacity. And this is what a lot of our audience probably has an interest in. This thing dropped like a rock, the LMI for transportation capacity in June. Now, it's still showing kind of a break even, if you will, right, in terms of overall. So it's not like it, but it is coming down from a pretty elevated level over the last couple of years. Now, this particular component of the LMI really translates well to some of our metrics like the OTRI and spot rates, like on when freight cycles are turning. And this strong downward shot here, what's your takeaway on it?
This is what we've been waiting for. is like, you know, the thesis statement. But essentially what this shows, like you said, capacity is at 50. Mm-hmm. It's the first time capacity has been at 50 since March of 2022. Okay, so think about March 2022. That's like right as the invasion of Ukraine happens, inflation goes crazy. And that really kicked off the freight recession, the events of February and March of 2022. And so now we're back to 50. And what's important about being back to 50 is transportation prices are up to 50 or to 61. Okay, so we now have transportation prices coming in 11 points higher than transportation capacity. One of the ways that we define whether we're in a freight recession or not is the delta between transportation price and transportation capacity. And we have now had 2 months in a row where transportation price is higher than transportation capacity. If we get to 3 or 4 months, then I think we can say the freight recession is over. I'm not quite ready to say it yet. I've been following Craig on Twitter.
Yeah.
Not just for the cool shots he takes out of the plane, but also for his opinions on the freight recession. So I'm not quite there yet. But I think it's coming. I do think, and unless something really crazy happens, you would expect these trends to continue. And that 61, by the way, for transportation prices, that's the fastest rate of growth we've had there since June of 2022. So we're in a good spot. We had, I think, 18 consecutive months maybe that transportation prices were down. And now in 2024, for the first time in January, we saw they went above 50. This is for price. And then we also saw that in May and June. Now in February, March, and April, capacity was higher than prices, and price went up and went down. And so really what the first 6 months of 2024 have been, to me, looks like a transitionary period where we see the lines kind of crisscrossing a couple times. But now we're 2 months into price being higher than capacity. And based on our early returns for July, price will, unless, the data is not complete, so you can't say for sure, but based on where we are 18 days in, it looks like price will be higher than capacity again, by a good amount. And so I would expect that this is telling us we finally have some capacity leaving the market. We also have an increase in demand. We talked about Port of LA and all the sort of movements and inventories happening upstream. To me, maybe, we can't say for sure if the freight recession is over yet, but this is what the end of a freight recession would look like. And I think there's a good chance that once we have a couple more months of data, we'll be able to look back and say, yeah, that was it right there.
I think that's a welcome statement for our listeners, but kind of keeping on the theme of pricing or prices, kind of shifting back over to talking not inventories, but looking at warehouse prices. I mean, they've been in expansion territory for quite some time. I mean, that where you have inventory levels where you feel like they're going to grow over the coming 12 months, you have warehouse prices going up. I mean, that seems like and then you have the transportation pricing. It means for me, it kind of reads like things are about to become more expensive across the supply chain for shippers. I mean, is that kind of the correct read when you look at kind of all three of those?
I think that's possibly true. Warehousing prices have been incredibly steady though, so far through 2024. Let me just read you the numbers since January: 64.2, 64.2, 66.3, 63.8, 64.9, 64.5. I mean, the range there is about 2. We've been very, very steady, and that's close to sort of what we would expect warehousing. Warehousing is different from transportation, where transportation, that's where we see wild swings. Those are the risk takers out there in transportation. And warehousing is more like, if this is a band, warehousing is the drum. It's just it's steady, and it kind of holds everything together in terms of the index. And so our prices look to be fairly consistent. The other thing is we've only had 1 month in 2024 where we saw negative capacity growth. And so, warehousing, one of the things that happens, I think, is we built a whole bunch of capacity in 22, and some of the capacity doesn't fit everywhere. Like, a manufacturer is not necessarily going to want a e-commerce, sort of urban warehouse that was built, for fast delivery and vice versa. But to me, it seems that warehousing is pretty steady right now. I mean, we saw Prolog just come out recently and say, yeah, we're pulling back a little bit, but maybe now we're focusing on data centers or whatever it is they're going to do. So to me, warehousing, the highs aren't as high, but the lows aren't as low as what we see with transportation. Now, there are certainly predicted to be some levels of price growth here. When we look at our future predictions, warehousing prices are 67.6. So again, all right, that's 3 points higher than what they are now. Compare that to future transportation prices. Those are 79.8, which is almost 20 points higher than we have now. And so that really, Tony, I think epitomizes the difference between these two metrics. Yes, warehousing is a source of cost, And some of this is caught up in inventory costs, by the way. Inventory costs are 75 for our future predictions. So there is, some of that's warehousing, some of that's the transportation piece. But it will not be as much of a swing, I think, and our respondents think, as the one we're going to see in transportation over the next year.
I mean, that's insane. 79.8 future outlook. Like that's fascinating to me in the way that we have all of these transportation managers expecting a pretty sharp turn in the market is what that tells me, based on where we are today. And I mean, that's incredible. But again, we only got 36 seconds left. So thank you so much. It was such a nice reunion. I don't know how your schedule looks in the fall with your teaching your students, but
I moved all my classes to the afternoon. I said, look, I need mornings for Freightonomics.
Let's go.
I'm wide open now.
Well, thank you so much, Dr. Zach Rogers, and thanks everybody for tuning in this week. Man,
a lot of insights.
That was a ton. Like, I got some stuff for State of Freight.